Welcome back to Sharing with Myhanh, Understanding Together, Peace Forever. In the previous video, we talked about inheritance in IRA and 401k, a topic that many families care about and often have questions and concerns. Starting today, I'm beginning a new series on IUL, Index Universal Life Insurance. This is a special type of life insurance that is getting a lot of attention, but at the same time is also one of the most misunderstood. I am an independent insurance agent and the founder of Tâm An Wealth and Insurance. I am licensed in both insurance and tax preparation, and I am also studying to become CFP, a certified financial planner. I believe that to truly help families prepare for the future, I need to always stay updated with deep, well-rounded knowledge in finance, investment, and retirement planning. When people hear life insurance, most just think of it as money left for their children after they pass away. But that's only part of the picture. If we stop there, we miss out the full value that life insurance and especially IUL can bring. Some even think IUL is a scam and not worth buying. The truth is, IUL only become a problem when it's designed incorrectly or does not match your financial goals. But if it's structured the right way, IUL can be a powerful and effective part of the family's financial plan. In this series, I will share a real-life examples to show you what a standard IUL looks like and how to decide on a safe funding level that won't overstretch your finances. We will also look at the different sources of money you can use to fund an IUL, whether it's come from income, savings, or converting other assets to keep your plan safe and effective. Not only that, I will compare IUL with other financial tools, such as stocks, real estate, and annuity. At the end of the day, IUL, stocks, real estate, annuity are all just tools, financial instruments that help you reach different goals. You can think of like tools in the repair kits. Each has its own purpose. Use it correctly, it works beautifully. Use it wrong way, it can do more harm than good. I will also talk about what to do if you already have an IUL contract but are not satisfied with it. My goal with this series is to help you see the true value of life insurance with IUL at the center. When designed and used properly, IUL not only protect your family from risk, but it also becomes a key part of comprehensive and flexible financial plan for the future. And in the first video of this series, I will cover what IUL is, how it works, how to tell the difference between properly designed and a poorly designed IUL contract. So let's get started. So what exactly is an IUL? When most people think about life insurance, the first thing that comes to mind is the death benefit, the money that protects your family financially if you pass away. But an IUL, which stands for Index Universal Life, goes far beyond that. It's a type of life insurance that also allows you to build cash value. This cash value grows based on a market index, such as an S&P 500. The key difference is that, unlike investing directly in the stock market, your cash value won't lose money when the market goes down because the contract has a built-in protection floor, usually 0%. What makes URL truly unique are the living benefits. If structured correctly, the money in your contract can be accessed tax-free through a policy loans. In other words, an IUL is not just insurance, it's a flexible tax advantage financial tool that protects your family while also helping you actively save, grow, and use your money during your lifetime. So, how does an IUL actually work? Let me explain in a simplest way. So, when you apply for an insurance, the first step is underwriting. That is when the insurance company review your health, your job, and some financial details. The purpose is to decide if you qualify for the contract, and if so, what your premium will be. If you are in a good health and have a low risk occupation, your premium will be lower. If your risk is higher, the premium is adjusted. Once you're approved and pay your first premium, the contract officially takes effect. From there, you continue paying monthly or yearly. Your premium is divided into two parts. One part covers the insurance cost to maintain your death benefit. The other part goes into your cash value account. Think of it like you own savings fund, but with the chance to grow alongside the market. Now, here is where IUL is different. The cash value is linked to a market index like an S&P 500, but it does not move exactly like the market. Instead, the insurance company set rules of the game to balance growth with protection. These rules determine how much return you actually get credited. And most importantly, they make sure you have a safety net. So even if the market go down, you won't lose money. There are four key parameters. First, cap rate. That is the maximum you can earn in a year. For example, if the market goes up 15%, but your cap rate is 10%, you're credited with 10%. If the market goes up 8%, but your cap rate is 10%, you are credited with 8%. Second parameter is floor rate. The minimum you will get, usually 0%. For example, if the market drops, you won't lose money. Your credited rate stays at 0%. Third parameter is participation rate. That is percentage of the market gains you get. For example, if the market rises 12% and your participation rate is 50%, you're credited with 6%. So you take 12% multiplied with 60%, it will come up with 6%. The last one is spread. The percentage subtracted from your gain. For example, if the market grows 12%, but the spread is 5%, your credited return is 7%. In short, these four parameters are how the insurance company shares the upside with you while protecting you from losses. Another unique benefit of IUL is that if it's designed correctly, you can access your cash value tax-free. You can use it for retirement income, your kids' college, emergencies, medical needs, or even business opportunities. And unlike an IRA or 401k, there are no early withdrawal penalties before age 59 and a half. As long as you have enough funds, you can borrow anytime with no fixed repayment schedule. If you don't pay it back, the balance is deducted from your death benefit. Of course, policy loans do accumulate interest, so it's important to use it carefully and strategically. Finally, IUL contracts are flexible. You can pay more, pay less, or even pause payments as long as your cash value is strong enough to keep the policy active. For example, if you short 1 month, you can contribute less and catch up later. But in the early years, it's very important to stay consistent with your payments to build a stable foundation. So in short, an IUL is not just life insurance. It's a flexible financial tool that protects your family, helps you grow money safely, and lets you access that money when you truly need it. Now, let's talk about how to structure an IUL policy. The way it's designed from the very beginning will directly affect how effective the policy is in the long run, both in terms of cash value growth and the insurance protection. On the left side, we have a death benefit focus designed. On the day one, the insurance amount, sometimes called death benefits or face amount, is set very high. This is the payout your family would receive if you pass away. At first, it might sound appealing, right? But here is the key. Because the death benefit is so high, most of your early premiums are used to cover insurance costs. Very little goes into your cash value. That means growth is extremely slow, and in the first few years, you might see little to no growth at all. The consequences of this design are higher insurance costs, slower cash value accumulation, limited flexibility if you want to use the money for retirement or other goals. The main advantage is that if you pass away, your family immediately receives a large tax-free payout. That is why this design works best if your primary goal is leaving a legacy or protecting family income if you are the main breadwinner. On the right side, we have a living benefit focused design. Here, initial benefit is set lower, which reduces insurance costs. It's allowed more of your premium to flow directly into the cash value. The results are faster cash value growth and give the ability to take tax-free policy loans when needed. The results are clear. Your cash value grows faster. You gain the ability to take tax-free policy loans whenever you need them. And your overall costs are lower. That is why this design is especially suitable for retirement planning, long-term wealth accumulation, and making the most of your policy benefits while you are still alive. Now that you understand the difference between a design that focuses on death benefits, also called direct design, and the one that prioritizes living benefits and cash value growth, known as the green design. Let's look at some real numbers to see the impact. Imagine a 35 years old woman contributing $20,000 a year for 21 years into an IUL policy. The premiums are the same in every scenario, but the outcomes are completely different depending on how the policy is structured. First, let's look at the non-cash optimized design or direct design. Here, the death benefit is set very high right from the start, $1.55 million. The agent commission is as high as $27,000. And for the first 3 years, there's no cash value at all. By age 55, the cash value is only $523,000, and the death benefits is still $1.55 million. As you can see, most of the premium go toward cover the insurance cost, which severely limits growth. Now let's make one small adjustment. We reduce the death benefits from $1.55 million to $1.05 million. The results improve dramatically. The cash value increased by $150,000, reaching $665,000. The commission dropped to $18,000, nearly $19,000. And there are only 2 years with no cash value. With this small change, this client, gains $141,000 more in cash value without paying a single dollar more in premiums. Finally, let's look at the cash optimized with increased death benefit design. That is the green design, the most efficient of the three. The starting death benefits is only $446,595. The commission is go down to $7,455. But by age 55, the cash value grows to $811,000 and the death benefit increase over time to $1.34 million. By simply restructuring the policy to prioritize cash value growth instead of maximizing the death benefit upfront, the client ends up with nearly $300,000 more in cash value with the exact same premiums. So as you see, with the same contribution, the way your IUL is structured makes all the difference in a long-term value you receive. That is why it's so important to first ask yourself, what is your main purpose for owning an IUL? Is it to leave a legacy, or to increase steady retirement income, or to build flexible financial access to your future? So hopefully, this comparison helps you understand how to structure an IUL so it aligns with your financial goals, and also helps you recognize whether your current policy is truly working in your best interest. Because when it's designed properly, an IUL is not just life insurance, it's a powerful, flexible, and sustainable financial tool that can support you both now and the years to come. So when talking about IUL, besides making sure the policy is designed correctly, an equally important factor is how you fund it. Why? Because if you fund it the wrong way, the policy won't grow as expected. In fact, you could even lose the tax-free advantage, which is one of the biggest benefits of IUL. The first rule is to avoid letting the policy become a MAC. So what is a MAC? MAC stands for Modified Endowment Contract. This is an IRS rule designed to prevent people from using life insurance purely as a tax shelter. If your policy becomes a MAC, the cash value still grows, but withdrawals will be taxed as ordinary income. And if you withdraw before age 59 and a half, you also face a 10% penalty. The key point is, even if you go over the MAC limit by just $1, the policy is permanently classified as a MAC. There is no way to reverse it. The second point is better to fund more money in the shorter period and to pay at the beginning of the year instead of monthly. This strategy is called front-load funding. It means contributing more during the first 5 to 10 years instead of spreading payment evenly over 30 years. Why? Because the money that goes in earlier has more time to compound, and your cash value grows much faster. And if possible, pay the full annual premium at the beginning of the year. This way, the entire amount starts earning interest right away, maximizing compounding. If you split it into monthly payments, each portion is only invested for part of the year, which usually leads to lower total growth. The third point, don't put all your money into a single index. For example, we can allocate 70% to S&P 500, 20% to fixed account, or 10% to a multi-index strategy. So this way will help you to reduce risk in case the company later change the cap rate. And finally, withdrawals. It reduces your cash value, slows down growth, and in some cases can even remove the tax-free benefit. Instead, use policy loan. This means borrowing against your own policy. The great thing is that your cash value stays in the contract and keeps earning interest while you borrow what you need to use. And as long as the policy stays active, these loans are tax-free. In the next slide, I'll share more details about how policy loans work and why they are much a smart strategy for creating tax-free income in the future. So to maximize the power of IUL, you need to design the policy correctly from the start. To fund it wisely, put in early and never exceed NAC. Monitor it regularly, and when you need money, prioritize using loans instead of withdrawals. So if you follow these steps, your IUL won't just protect your family, it can also become a flexible, reliable, and tax-free source of income for your future. Let's talk about one of the most powerful features of an index universal life policy, the ability to access your money tax-free while it continues to grow. This is done through policy loans. Think of it like having your own family bank you can tap into anytime. No loan application, no credit checks, no income proof. When you take a loan from your IUL, your cash value does not shrink. It stays in the policy and continues to grow interest as if you never touch it. For example, if your policy has $100,000 and you borrow $20,000, you still earn interest on the full $100,000, not just $80,000 left. That is a huge advantage compared to a traditional savings or retirement account where your money stops growing the amount you take it out. Second, there is the interest offset advantage. Yes, there is interest on the loan, but the growth of your policy can often offset or even exceed the borrowing cost. For example, if your cash value is growing at 7% and your loan interest is 5%, you're still ahead by 2%. That is what we mean when we say your money is doing double duty. It keeps growing while you are also using it. Third, there is no mandatory loan repayment. Unlike a bank loan, there is no monthly repayment requirements, no penalties, and no impact on your credit. You decide when to repay. What happens if you don't pay the loan back? It's simple. The amount you borrow plus any interest is deducted from your death benefit. For example, if your death benefit is $500,000 and you have a $50,000 loan outstanding, your family could receive $450,000. So the bottom line is IUL policy loans give you access to your money tax-free without interrupting growth and with complete flexibility. Families use this strategy to pay for college, remodel a home, start a business, cover emergencies, or supplement retirement income. That is why we often say an IUL is not just life insurance, it's a bank of you. Thank you so much for watching today's session. I hope that what I have shared gives you a clear picture of IUL, how to design it the right way, how it works with cap, floor, participation, and spread, and especially how to fund it correctly so it can grow well and provide long-term tax benefit for your family. If you found this helpful, don't forget to like and subscribe so you don't miss my next videos. And if you have any questions, feel free to email me at tamangwealthhealth@gmail.com or call me directly at 408-513-7350. I'll be happy to take the time to answer and help you find the solution that best fits your goal. I will see you again in sharing with Myhanh, understanding together, peace forever. Wishing you and your family good health, peace, and happiness.